everyone. So this is Rama Chunhu, founder of Fushan Investment Group. I have 15 plus years of experience in IT side and also investing in multifamilies, active and passive side. Currently, we are focusing on Southeast markets like North Carolina, South Carolina markets. I'm the host of Multifamily AP 360 virtual conference and podcast also. So with that, I will introduce Thomas Castley from Tax Strategist. Little bit about Thomas. Thomas is a tax strategist and investor who helps real estate investors keep more of their hard-earned dollars in their pockets and out of the governments. Over his tax career, he has worked one-on-one with 100 plus investors to help them reduce their tax bills. On the investing side, he was on the sponsorship team of an 82-unit apartment community and has invested in multiple syndications and funds as an LP. So with that, Thomas, you want to add anything to your background and take it from here?
Yeah. So, as Rama said, my name is Thomas Castelli. I'm a tax advisor and a partner at a firm called Whole CPA, where we exclusively work with real estate investors all across the spectrum. And my personal investing experience, I've been investing as a limited partner in real estate syndications since 2015. I had the opportunity to participate on the sponsorship team of an 82-unit apartment complex in Jacksonville, Florida. Back in 2017, we ultimately sold that in 2020, and since then, I've been mainly on a limited partnership side because I'm very busy helping our clients minimize their taxes. So, kind of what we'll be going through today is a little bit of an overview on how passive losses work for real estate investors, and then a strategy that you can use to help minimize your taxes as a limited partner or as a passive investor on your real estate holdings. All right, so I'm going to start off with a quick overview of passive activity losses, and we'll go from there. All right, so before 1986, you used to be able to buy a rental property or invest in a real estate syndication or a fund that's structured as a partnership and take the losses from that syndicate or fund or that rental property that are typically generated by depreciation expense and use those losses to offset your W 2 or active business income with no questions asked. But, and the reason why this is so powerful, before I go any further, the reason why people want to do this in the first place is I'm sure you're aware, but just in case you're not, depreciation is a non cash expense. So, in other words, you're able to use this non cash expense to reduce your taxable rental income, but with not taking money out of your pocket. So in other words, you're able to reduce your taxable rental income despite the fact that you're generating positive cash flow. And since 2017, with bonus depreciation, this deduction has been even more powerful as you're able to accelerate certain components of property and really boost up this depreciation expense in many cases. So that's why it's so powerful, and that's why people invest in real estate and like to use the losses, because they're not really losses, they're just on paper. All right. So again, back in 1980, before 1986, you were able just to buy properties or invest in syndicates, take the losses against your ordinary income, W-2 or business income, no questions asked. But this became very controversial because a lot of doctors and highly compensated lawyers and other highly compensated individuals at the time were using rental real estate as a way to reduce their taxes and without doing really much work. And so what Congress did was, in the Tax Reform Act of 1986, which was passed under President Ronald Reagan, was they introduced the passive activity rules. And the passive activity rules did two things. The first thing it did, it was make all rental activities passive by default. And what that meant is that passive losses can only offset passive income. And they also made businesses either passive or non-passive based on whether or not you materially participated in that business. So that's kind of two things that happened. We're mainly going to be focusing on the rental real estate side here, but that's kind of what happened in a nutshell. Now, as a limited partner if you're investing in syndicates and funds, you're going to be on the passive side. All right. There's only really one true way to get it over to the active side if you're investing on this, and that's to acquire your own rental portfolio, qualify as a real estate professional, and then group all of your rental activities together as one. But we're going to assume that most people are not doing that. So what strategies are available to you as a passive investor, right? So the first things first to realize is that if you're investing passively, chances are the syndicator, the sponsor of the deal, is going to be using cost segregation studies in that first year, and or using a value add structure that's going to generate losses. Now, again, these are usually non-cash losses, so you're probably generating cash flow from these deals. You might be getting distributions from these deals, but you're not necessarily paying tax on them. And that's the first benefit of investing in real estate and investing as a passive investor, is you're generating cash flow, but you're not paying taxes on it. And this is important because rental income is taxed at 37%, at your ordinary tax rates up to 37%. So if you're able to shelter this, basically you're earning more money, but you're not increasing your effective tax rate. So that's the first benefit, and that just comes almost naturally. Now, the second benefit is that you're able to use these losses to offset the gain on sale of rental properties, or when a syndicate or fund is liquidated and properties are sold for a gain, as you would hope they are, you're able to use these losses to offset your gain on sale. So, as a limited partner, as a passive investor, this becomes a timing game. So, your passive losses are reported on your form 1040 on a form called 8582. So that's form 8582, passive activity limits. And what happens is when you have a passive activity loss, right? So say you invest in a syndication. What's going to happen is you're going to receive a K1 when that tax return is filed, and that represents your share of the income, losses, deductions, so on and so forth from that partnership. And again, if you're doing it with rental real estate, chances are in box 2, where it says rental income of your K1, you're going to have a big loss, especially in the first year. Now, what happens to this loss is this loss will offset any rental income that you have, whether it be from this property or another property that you own. And if there's still any left over, it will be carried forward to future years and will be able to offset income in those future years. And the reason why this becomes important is because you want to monitor that form 8582 to see how much suspended passive losses you have for future years. And the reason why you want to do that is so that you can take a look at this year and say, do I have rental income? Am I expecting positive rental income or net rental income that I might have to pay taxes on? And do I have enough passive losses to offset that? If you have enough passive losses to offset your rental income, check the box, you're good to go. Now, if you're expecting a syndication to be sold, or you're expecting a property to be sold this year, and you expect to have a gain, the question you're going to ask yourself is, do I have enough suspended passive losses from my prior year tax return? So if we're looking at 2022, you'd be looking at your 2021 tax return. Do I have enough suspended passive losses to offset the expected gain on sale? If you believe you do, then check the box, you're good. Nothing else is needed. Now, having said that, if you look at your form 8582 and it does not appear you have enough suspended passive losses on your return, well, what can you do? Well, the good news is you can invest in another syndicate or another property this year, or the year, whatever year your property is being sold, and you can use the losses that will be passed through via that form K1 from this year against the gain on sale of the property that's also being sold this year. So kind of just to summarize that there, if you're expecting a property to be sold in any given year, you're going to want to pull up your form 8582. You want to take a look to see how much suspended passive losses you have left on your form 8582. And you're going to ask yourself, do I have enough suspended passive losses to offset the anticipated gain on sale? If yes, you're good to go. If no, you're going to want to consider investing in another property, whether it be a syndicate or a fund or a property you maybe buy directly. And you're going to want to use those losses from that property to offset the gain on sale of your syndicate. So that's kind of the biggest component of this in a nutshell. Now, there's a few other things I do want to mention. You are going to just want to be cognizant of, you're going to want to be cognizant of when these properties are being sold, right? You're going to want to have an idea. And usually the sponsors will tell you 2 to 5 years, 3 to 7 years, whatever the case is, and when they have an anticipated sales date. They also generally update you with quarterly updates or semi-annual updates, and they'll typically let you know if they expect to sell a property sooner than expected. And this is something you're going to want to stay on top of. Again, and I'm going to just drive this home again. You want to be able to take a look and monitor that suspended passive losses. So if a property is to be sold, you can take a look and see if you have enough passive losses, or you can make an investment decision. Now, the second thing to kind of cover here is that 100% bonus depreciation begins to phase out in 2023. So if you've been investing in syndications for the last 5 years, since 2017, bonus depreciation has been at 100%. And that's creating big losses for you when you invest in most syndicates. So we've been seeing people get back 70 to 90% of their, in some cases more, of their initial investment in a loss in the first year. So if you're used to seeing these big losses on your tax returns, that might start to phase out as bonus depreciation phases out. Because again, bonus depreciation is going to phase out, is going to phase down to 80% in 2023, 60% in 2024, 2025 is going to be 40%, in 2026 is going to be 20%, and in 2027 it's gone. So the reason why I'm telling you all this now is because if you're expecting to have properties being sold in 2023, 2024, 2025, you're going to want to go ahead and take a look at your Form 8582 today, and you're going to ask yourself, do I have enough suspended passive losses to offset these gains that I'm expecting over the next handful of years? Because if not, and you have the money to invest and it's part of your investment plan, you may want to consider making an investment this year before 12/31/2022, so that you can maximize your and take advantage of bonus depreciation while it's still at 100%. Because again, even if you can't use all those losses this year, they will carry forward to future years and will be available to offset gains on sale in future years. Okay, so that's the biggest thing to just take note of, is this year would be ideal to invest and get these losses. Now, bonus depreciation is still going to be pretty powerful in 2023 while it's at 80%, and 2024 while it's at 60%, but it does of course fade. So, I mean, I think in a nutshell, again, just to summarize this, as a limited partner, you're not able to take losses against your W-2 or active income when you have losses from a syndication or a fund, because that's just the way the laws are written. That's what was put in place in 1986. Okay, and then the name of the game as a limited partner from a tax perspective is you want to make sure you have enough current and suspended losses to offset your rental income. And in many cases, you will be covered, and in many cases, you won't have to worry about this. But something you do want to keep an eye on. And secondly, you want to make sure you have enough suspended passive losses to offset the gain on sale of any syndications or funds that you're currently in. And the reason why you want to offset this, I guess I forgot to mention this. The reason why you do want to offset these taxes is because of the time value of money, right? If a syndication sells and you're going to owe, let's just call it $50,000 in taxes, just to keep it a number easy. Well, that's another syndication investment, right? You can make another syndication investment with $50,000 and continue to grow your money. So if you were to take this $50,000 and you were to invest it, so let's put it this way: if you were to take this $50,000 and pay the IRS, well, now that money is gone. You're never going to see that money again. But if you could take that $50,000 back because you were able to shelter it with rental income, and you were to invest that $50,000 over a 10-year period at an 8% compounding return, well, that's going to be sizable. And we know that 8% is pretty low when it comes to real estate. Even as the market begins to tighten, 8% is pretty much is a conservative return. So what would that look like for you? Well, it's going to be over a 10-year period. You would basically get back. So if you were to invest $50,000 at an 8% compounded return in a 10-year period, you would make roughly $57,100 back, right? You'd make that money back. That's money on top of so you'd get a total of $107,500 But when you take your principal out, you would make $57,500. Now that's $57,500 that you earned on that money that you wouldn't have been able to earn if you had just paid the taxes. So that's why you want to offset your taxes when it's possible, so you can keep growing your wealth. And that's one of the big benefits of real estate. Very hard to do this with other assets that are not in your very hard to do this with assets that are not in tax advantage accounts like an IRA or a 401k. But with real estate, it's very possible. So, I mean, that's pretty much the gist of it. I'm happy to answer any questions anybody has or add clarity to anything.
So, what are the most common mistakes people make when it comes to passive investing and taxes?
Yeah. So the most common mistake is thinking this when we get this a lot. Is thinking that you'll be able to take the losses from your passive investments and use them to offset the income from a job or an active business that you're running. A lot of investors get confused or get mixed up and believe this is possible. And unfortunately, it's just not possible anymore in the vast majority of cases, because of the Tax Reform Act that was passed in 1986. So that's one of the mistakes that we see. The second mistake that we see is that taxpayers will get the K1, they'll report it on their tax return, or they'll have their accountant report in their tax return, and either they or their accountant will forget to carry forward the Form 8582 year over year. So this is a form that's reported on is reporting your tax return every year that you have passive losses. Even if you didn't have any passive losses from that specific year, your Form 8582 still should carry forward because it has those suspended passive losses. So that's a second mistake. You want to make sure that that Form 8582, and I know I said a lot, but it's an important form. You want to make sure that's being reported on your tax return each and every year. Okay. The third thing is failing to tax plan, right? Because again, a lot of investors think that you could just 1031 exchange, right? So if you're a limited partner, you're not going to be able to use a 1031 exchange. And the reason for that is because a 1031 exchange, when you're doing that, you have to exchange real property, so real estate, for another piece of real property, again, real estate. And when you're investing in a syndication, you're investing in a partnership and you're receiving a partnership interest, and the partnership is investing in real property. So what your investment represents is a partnership interest. And unfortunately, you cannot exchange a partnership interest for real estate, or you can't exchange a partnership interest for a partnership interest in most cases. So this is why what I mentioned before becomes so critical, because your biggest tax strategy that you have available to you as a limited partner is your ability to use these passive losses that you're getting from these syndicates, again, that are generated by that are typically generated by depreciation, to offset these gains and your rental income as it arises. So I'd say those are probably okay. And the last thing, the last maybe one or two things, is failing to understand that you are investing in a partnership, and these partnerships can be complex at times, and you're not always going to get your K1 right away, right? I know in an ideal world, everybody would want to get their K1 with enough time to file your personal tax return by April 15th. But I've been doing this. I've been investing as a limited partner. Well, I'm in a tax account, and I've been investing as a limited partner since 2015. Okay. And I can tell you that even the most professional sponsors that you'll ever work with struggle to get K1s out on time. And it's the nature of the game. So don't necessarily be mad at your sponsor because they didn't get you to the K1 on time. There's a lot that has to go into filing those partnership tax returns before the tax filing deadline. So in many cases, they will be extended, and that's just the nature of the game. So just understand that, and just make sure you have that expectation that you're probably going to have to extend your personal return. And the last thing I want to say in there is the state tax issues, right? State taxes. So when you're investing as a limited partner, you're investing in the partnership, and the partnership also has to file state tax returns. So let's say you live in, I'm just using an example. Let's just say you live in New York. I live in New York. And let's say that I'm invested in a syndicate, or maybe you're invested in a syndicate that's invested in Oklahoma. and I'm just pulling a name out of a hat. Could be Atlanta, could be it could be, excuse me, Georgia, could be Kentucky, could be North Carolina, South Carolina, so on and so forth. Well, each of those states that you own property in, or the partnership owns property in, needs to file a state return. And you're going to get a state return through the K1. You're going to need to file that state return in many cases on your personal return. So just know that. So just be aware of that. You're probably going to have to file some state returns that you may not have normally filed if the partnership owns property in those states.
Is there any way like we can offset W2 income? Is there any options available?
So there are two ways you can really do this. The first one is what you have to do is you would have to own your own portfolio, or you have so you have to qualify as a real estate professional. So that's the first step. So to qualify as a real estate professional, you need to work more than 750 hours and more than half your total working time in a real property trader business. There's a lot of different types of real property trader businesses, but they're typically going to be you're a real estate agent or broker. You fix and flip properties. You're a property manager. You're in construction. You're in development, or you're in rental real estate. So if you do this and you can meet those requirements I just mentioned, then what you're gonna have to do is you're gonna have to make sure that you spent at least, more than 500 hours on your own rental portfolio. So in other words, you have a rental portfolio that either you're a general partner in or that you own, you own directly yourself. And if you can meet that requirement, you can make an election. This election is called it's under section 1.469-9G. It's called the real estate professional grouping elections, often referred to. And that makes all your rental activities one for tax purposes. And when you do that and you invest in syndicates, then those losses also become non-passive because you're a real estate professional. So just to recap that, one way to take losses from limited partnership interests is by becoming a real estate professional or being a real estate professional and grouping all your rental activities together and so that your limited partnership interests get grouped together with properties that you own and control yourself. And then you could take losses. Now, the second way you could do this, and I got to admit, this is rarely seen in practice. Okay. So it's really not too practical, but it could be done. When you sell a property or a syndication liquidates, and if that syndication has losses that are still associated with it, after offsetting any passive income you have for the year, any gains that you have for the year, including the gain on sale of that property, if you still have excess losses from that property, those losses will become non-passive at that point when the property is sold. And then those losses can offset your income. Now, again, just to recap, in order to get there, you need to first have more losses than your rental income, more losses than the gain on sale, and for all your properties that year. And then at that point, if there's still losses remaining from that property that was sold, then you can generally use it to offset your active income at that point. But again, it rarely happens in practice. I very rarely see that actually occur and the reason why it rarely occurs is because you'll probably end up using most of your passive losses to offset the gain on sale from the property, especially in this market where it's been appreciating for the last 10 years or so. That's kind of what ends up happening.
So what is the best strategy to not pay a lot of taxes if you are flipping houses and keeping them for less than a year?
What is the best strategy? Not pay taxes if you're flipping properties and keeping them for less than a year. Well, the best thing you could do in that case, I assume you're actively flipping properties in this case. So the best thing you could do is qualify there's two things. I'll give two or three things. First thing is you can qualify as a real estate professional. If you qualify as a real estate professional and you invest in rental properties, you can use the losses from those rental properties you own, assuming you are actively involved in them, against your W-2 or active business income. So, and your active business income in this case would be flipping properties, right? So if you're able to qualify as a real estate professional, you materially participate in your rental activities, then you'll be able to take those losses. That's probably the best way, because if you're flipping and you're able to meet the real estate professional status, you're already moving in the right direction. The second way you could do it is if you can't qualify as a real estate professional, maybe flipping is not what you do full time, or you're otherwise not able to qualify as a real estate professional, then you could invest in short-term rentals. So short-term rentals have an exception under the tax code. So if you recall what I said in the beginning of this webinar today, the section 469 made businesses either passive or non-passive. And short-term rentals, if you have an average stay of 7 days or less on a short-term rental, then the short-term rental is not considered a rental activity. What does that mean? It means it's not passive by default. And if you materially participate, which typically means you're self-managing the property for all intents and purposes, then you'll be able to take the loss from that short-term rental against your active income, despite the fact that you're not a real estate professional. So that's another way to do it. And then the last way to do it, and this is really minor, this isn't going to make a significant dent in many cases, but something to be aware of, is if you're flipping a lot of properties and you're flipping it and that's your primary source of income, you might want to consider you doing this under an LLC that you can have taxed as an S corporation. And then what you can do is you can pay yourself a salary out of that S corporation. It does have to be appropriate. So you might have to work with your tax professional to figure out what the salary is, and as well as, does the S corporation even make sense in the first place? Because it might not always make sense for your situation. But having the S corporation and paying yourself that salary can minimize your exposure to the self-employment tax.
Can we take this loss in home country also, since he is from Canadian? So those losses on K1, can we take these losses and file Canadian taxes in loss?
Yeah, that's a good question. I'm going to be completely honest. I'm not very familiar with Canadian tax law. So I do not know if the Canadian tax laws allow you to do that. My focus is primarily on the U.S. Tax side of things. So I would just not, I don't know offhand. I can't answer that question.